Hello everyone. Today our team will present to you the net zero portfolio pitch and the investment analysis that follows. Our team has 4 members: Umair Abdullah Khan, me, Supraneet Saxena, Yajur Sondhi, and Shashwat Devgan. Sustainable finance has grown rapidly in recent years. ESG investing has evolved from socially responsible investment philosophies into a distinct form of responsible investing. While earlier approaches used exclusionary screening and value judgments to shape their investment decisions, ESG investing has been spurred by shifts in demand from across the finance ecosystem. The lack of comparability of ESG metrics, ratings, and investing approaches makes it difficult for investors to draw the line between managing material ESG risks within their investment mandates and pursuing ESG outcomes that might require a trade-off in financial performance. Despite these shortcomings, ESG scoring and reporting have the potential to unlock a significant amount of information on the management and resilience of companies when pursuing long-term value creation. Now, we will focus on why you as a client should choose us to handle your portfolio.
Thank you so much, Supraneeth. Now let's talk about the vision. In accordance with CU's vision of being a socially responsible and ethically minded institution, we want our investment strategy to follow the same pathway. However, in terms of sustainability, we also have to consider financial sustainability. However, there are models and playbooks we can follow, such as the Yale model. Now, CU and the universities it represents want to protect their principal from a wide array of risks that it faces, from inflation to geopolitics and more. And as we said, they're a socially responsible institution, so they want to make sure that they're building the best return on investment and return on society within the criteria and goals they've given us. Luckily, there are ways we can do this, as many companies and asset classes are already publishing information as well as their roadmaps to achieving their own carbon neutrality and emissions control goals. And so we believe we can manage our portfolio and change it incrementally to achieve those goals by 2032. Now you might be wondering, is this on trend? Is there a market that we can actually invest our money in that meets those goals? In short, yes. Basically, nearly every asset class and the vast majority of companies across the world are already beginning to release ESG and emissions data, as well as roadmaps about how they're going to improve to reach their own goals. And also, capital market players are realizing that this is the smart money move. The more we can preserve and prevent global warming, the smaller the amount of damage it's going to do to the portfolios of investors everywhere. And therefore, not only is this a fiscally sound decision, it's the morally responsible one.
Now, moving on to discuss our portfolio, I will first talk about the selection criteria we used when it came to choosing our securities. The first step involved shortlisting products based off their ESG metrics, particularly the ones related to carbon emissions, for example, metrics like carbon intensity, MSCI ESG ratings, and fossil fuel-based revenue percentages. Therefore, we had to utilize rating agencies like Morningstar and MSCI to compile this data. Second, we prioritized favorable and sustainable financial indicators, as one of our major priorities included generating returns greater than the nominal interest rates and relevant existing benchmark returns based off various financial indexes. Finally, we focused on securities that had a low volatility, low risk profiles, capital protection, and those which would give us stable returns. For this purpose, we chose to include products like real estate investment trusts and treasury inflation protected securities. We also prioritized diversification, and hence all our securities, both bonds and equities, were exchange traded funds. When it comes to the portfolio composition, we observed that the pre-existing portfolio had several flaws. Around 60% of it was composed of equities, and that implied a higher level of volatility and risk. We felt that the endowment fund should not only be low risk, but should also offer a level of stability and capital protection. Therefore, in our portfolio, we relied very heavily on bonds and inflation protected securities, which we felt would give us more stability. For our equities portion, we included real estate investment trusts ETFs, which again had the similar aim of giving us stable, low risk returns. For a more specific breakdown of our portfolio, I will go over the Canada specific equity portion of it. Here we primarily chose products that indicated early net zero goal achievement. We preferred products that had major investments in sectors like financial services, technology, and green energy. We observed that the 3-year volatility as well as the returns of our chosen securities in the Canadian equity section were better than the benchmark S&P TSX 60 index. Moving over to our emissions profile, for Canadian equity products, we saw that the CO2 emissions in tons per $1 million in sales for the holdings in our various ETF products averaged to around 171.34. We compared this figure to S&P TSX 60 index ETFs and found that their emissions were around 300 tons, hence indicating that our portfolio was almost twice as efficient compared to existing products in this segment. We also included fossil fuel based revenue metrics and saw that on average, only 6.6% of our portfolio holdings relied on fossil fuels to generate revenues.
For our global equity portfolio, we decided to pick ETFs that are focused on developed markets with ESG criteria in mind. Similar to Canadian funds portfolio, we focused on sectors such as financial services, technology, and green energy. This will help us achieve our goal of net zero emissions by 2032. We allocated 5% of our total portfolio to each ETF in our global equity portfolio, and when compared it with the Dow Jones Global Index, which we used as a benchmark, our fund achieved substantially higher returns while being slightly more volatile. In terms of ESG profile, our ETFs were picked based on high MSCI ESG rating. This is in line with our ambitious goal of achieving net zero target by 2032. Other metrics that were also evaluated included carbon intensity, which measures the greenhouse gases emissions per $1 million in sales, and the percentage of revenue driven using fossil fuels. We made sure that the ETFs we picked were of the highest quality and had low carbon intensity, also had lower fossil fuel based revenue income. For our bond portfolio, we targeted ESG based global bond ETFs. This is mostly done to take advantage of numerous green projects initiated by governments not only in North America, but also in Europe. Our bond fund has a lower volatility as compared to the benchmark, which is FTSE Canada Universe Bond Index. Therefore, we allocated about 50% of our portfolio in bonds in order to maintain a lower risk profile of the overall portfolio. We invested about 32% in Treasury inflation protected securities, while 6% in each 3 green bond ETFs. This is to take advantage of the lower risk associated with TIPS. Even though Treasury inflation protected securities have a lower ESG rating compared to other bond ETFs that we selected, we allocated it a higher percentage due to its lower risk profile. And this is in line with the goal of capital protection that is the priority for the endowment fund.
Here, we will be making portfolio comparisons between our proposed portfolio and the pre-existing portfolio. The comparison will be in terms of financials. In terms of the 3-year returns, from our weighted average approach, we found out that our portfolio has a return of about 10.98%. This is a healthy 2.73 percentage points higher than the returns of the pre-existing portfolio. Canadian equities fare better by 1.50 percentage points. Global equities fare better by a healthy 7.08 percentage points, and bonds fare better by a healthy 1.18 percentage points. In terms of 3-year volatility, we find that from our weighted average approach, our portfolio has a volatility of about 10.86%. This is lower by 0.81 percentage points than the volatility of the pre-existing portfolio. Canadian equity and bonds both fare better here. Canadian equity are 1.64 percentage points lower, whereas bonds are 1.06 percentage points lower. Global equity are a meager 0.51 percentage points higher in terms of volatility. Here, we will make portfolio comparison between the proposed portfolio and the pre-existing portfolio in terms of ESG factors. In terms of carbon intensity, from our weighted average approach, we found that our portfolio has a carbon intensity of 149.85 points. This is a healthy 140.87 points lower than the carbon intensity of the pre-existing portfolio. Canadian equities are 199.28 points lower, global equity are 159.71 points lower, and bonds are 14.6 points lower than the carbon intensity in these categories of the pre-existing portfolio. In terms of revenues from fossil fuels, our portfolio generated around 2.66% of revenues using fossil fuels. This is lower by about 2.72 percentage points of the revenues of the pre-existing portfolio. Here again, Canadian equities and bonds unfortunately are earning a higher percentage of the revenues from fossil fuels by 0.26 percentage points and 0.38 percentage points respectively. This is, however, more than compensated by the global equity, as they are earning 4.88 percentage points lower in our proposed portfolio. Now we discuss the portfolio management strategy going forward. Here we are thinking of having a four-pronged approach. First, decarbonization of the portfolio. Second, tracking emissions matrices of all the holdings of portfolio under scope 1 and scope 2. Third, maintaining low risk profile in line with the goal of capital protection. Fourth, quarterly monitoring based on filters including ESG, low volatility, and optimal performance.
In order to make sure we achieve our goal of net zero emissions by 2032, it is very crucial for us to track our progress. Our firm will look to track these funds consistently and aim to reduce carbon dioxide emissions by 16 to 29% by 2025, which is in line with the target mentioned in AOA target setting protocol. We plan on using both carbon intensity as well as absolute carbon emissions metrics to have a better understanding of the underlying security, and therefore we can measure its performance more efficiently. KPI metrics would not only be adjusted for growth experienced by specific regions, but it would also be dynamic based on different methodology used for various sectors like real estate, energy, transportation, and steel. Moreover, we look to improve tracking and reporting of Scope 3 of the underlying securities.
Now let's take a quick look at the limitations and the roadmap we're going to take to get around them. First off, there are of course limitations around the data, its quality, the timeliness, and the validity of it. However, the simplest and easiest way for us to get around that is to adapt. And luckily, with a monthly reassessment cycle, we are able to take a look at our entire portfolio, look at the leading companies, leading assets, and lagging ones, and readjust our portfolio to meet its goals accordingly. Furthermore, in terms of our roadmap to the future, we can easily assess the performance of firms based on their adherence to their own goals and their ability to make detailed reports about their entire series of scopes of emissions. Furthermore, we can look for new opportunities to vet and assess these internal metrics with external data to allow us to further make adjustments. And finally, in case of unexpected situations that are extremely disruptive to the asset or the company's valuation, such as geopolitics, scandals, or direct attempts to mislead investors, we're able to have the flexibility to divest out of those assets in a smooth and efficient manner. And on a final note, I'd like to say thank you once again